Sean Dilweg is the insurance commissioner for the state of Wisconsin. He joins us now here on set in New York. Commissioner, welcome to Bloomberg News.
Thank you, Mark.
What type of changes are you looking for?
Well, I think we've been looking at how the credit rating agencies interact with insurance regulation, and we've found over the last 10 years that in some areas of valuing assets, we've relied solely on the credit rating agencies. And with what's been happening over the last few years, we cannot continue to do that.
What specifically gives you problems? Were any of those things mentioned at that hearing yesterday on Capitol Hill?
Yeah, I think the hearings really kind of show some of the, how a for-profit entity is skewed towards higher ratings as, as they're being paid to rate the various entities. And
not enough checks and balances for you?
Correct. I mean, these are supposedly nationally recognized organizations, and what's behind that?
What I'm interested in is potentially changing of the insurance capital requirements. And what I find interesting here is that the ratings agencies, if you believe the ratings at the time, the insurers actually would have been carrying too much capital. What changes are you looking for? Like, why don't we give us that?
Right. I think, we are doing a top-down review of how much we rely on them. As you look at the Konjorsky bill and how much the federal government relies on them, I think half that bill is looking at where they show up in federal rules and regulations. So we're doing the same with all 50 state regulators. We're looking specifically at residential mortgage-backed securities. This year, we looked at municipal bonds last year that were wrapped by financial guarantors. So what you're starting to see is really a decoupling by the regulators to move away from the credit rating agencies.
But I guess bottom line, what I'm asking is, will the capital requirements for the insurers be changing, that they will actually have lower capital requirements?
I look at it as a more exact capital requirements. If you have a $1 billion security and 3/4 of it is Alt A and subprime, that's going to be moved to junk, but that remaining quarter is prime and could be valuable and should be counted.
Why did the regulators rely so heavily on the ratings agencies before the crash? Were they the only game in town?
Well, I think the rating agencies serve a purpose. They'll continue to serve a purpose, but there was pressure from industry for us to use them. And that pressure built over a decade that we should rely on them more and more.
So who's the watchguard now? Who's the vanguard?
I mean, right now we're really...
But apparently critics say it wasn't the SEC.
Correct. Correct. I mean, that's the issue, is how strong will the SEC be moving forward. I think not until 2007 did they do more than just register these entities.
Well, at the same time, when you look at the reliance of the insurers on credit agencies, for example, in good times it was beneficial to insurers. Now it's not so beneficial to insurers, right. And we're talking about getting rid of it. Isn't this pretty convenient for the insurance companies?
I think, you could argue live by the sword, die by the sword is kind of what you're pushing, Julie. But if we can look at various tranches of a security and give a value to that, I think we should. And that's what we're looking to do this fall on residential mortgage-backed securities. But they're used in a whole other area, a whole wide variety of regulatory tools for us.
Sean Dilweg, the insurance commissioner of the state of Wisconsin, joining us here on set in New York. Commissioner, thanks so much.
Thank you, Mark. Thank you.